Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. In the wake of last week's quarter-point rate rise by the Bank of England, taking rates to 4.5%, we'll try in today's session to give the UK economy a health check and see what this means for investors. For the last few years, the UK has clearly underperformed peers, and the country remains the only G7 member that is actually smaller than it was on the eve of the COVID outbreak. Recent data, though, has been encouraging. In the face of massive strike action, rising interest rates, and stubborn core inflation, business surveys are positive and are generally ahead of those in Europe and the US. From an inflation perspective, too, there are also tentative signs that labour market pressure is easing. Unemployment has ticked up to 3.9%, while the surge in job vacancies appears to have peaked. Yes, there are still material challenges. The full impact of mortgage increases has not yet been felt. 85% of UK mortgages today are fixed rate. Consumer confidence remains weak, while headline inflation looks stickier than in Europe or the US. Nevertheless, investor confidence is recovering as the Sunak-Hunt duo continue to stabilise financial markets. We'll look at all these issues in the slides ahead and assess what they mean for your portfolio. So let's begin by looking at the historic GDP data, and I've indexed this at 100 on the eve of COVID. And you can see in that left-hand panel now, the US is 5.3% larger than it was pre-pandemic, the euro area 3% larger, the UK 0.5% smaller. You can see the problem. Can this change? Can the UK catch up? Well, there are beginnings to be some indicators to say, yes, this might be possible. In the right-hand panel, I've shown the Citigroup Economic Surprise Index. This is above zero when economic numbers come in better than estimates. And you can see that dark blue line of the UK has started to rise quite sharply, just as the US and the euro area number has been falling. So suddenly the tempo of surprise is in favour of the UK. In the second chart, you can see in the left-hand panel the Purchasing Managers Indicator. We looked at this before. These are business surveys. Above 50 means net growth, below 50 means contraction. The UK there at 54.9, that's a good number, suggesting real growth that will probably avoid recession, and interestingly again, higher than the euro area or the US. In the right-hand panel, I've looked at some numbers which are peculiar to the UK. First of all, the bottom right-hand panel there in red, the working days lost due to industrial action, at last beginning to roll over from numbers that frankly looked as bad as they were in the Thatcher era. As we see today, some of the industrial disputes begin to settle. Up above those, I've shown that UK consumer confidence number, which has been so weak. That's beginning to improve as the underlying economy does itself. So these tempo slightly better numbers, where are the threats, where are the risks? Well, of course, we haven't seen the full impact of higher mortgage rates yet here in the UK. In that right-hand panel, that big purple block is the percentage of UK mortgages that are floating rate. At about 70% 10 years ago, that shrunk to just 15% today. A big chunk of fixed rate mortgages at 2 years or less in orange, and this very big chunk in light blue of rates fixed for more than 2 years. So that traditional shock you had as soon as interest rate rises, you hit the UK market, housing market very hard, is not, I think, likely to repeat this time. What's the effective rate of mortgage increase that we've had looking across the whole spread of mortgages? Well, the Bank of England has usefully made an estimate. In that left-hand panel, that's the purple line, and it shows a tightening of about 0.7% relative to interest rates, or mortgage rates have risen by 4% or more. So of course that'll kick in months to come, but it's very helpful today. The second risk, of course, is an ongoing wage price spiral. As you can see in the left-hand chart there, average weekly earnings in the UK have been rising, particularly the government payments up by 5.6%. Private sector at 7% though, beginning to show some signs of stabilisation, possibly rolling over. And what is encouraging in that bottom bar, UK job vacancies, at last they're beginning to fall. They were way in excess of the unemployed pool, which puts less pressure on starter salaries. That's not to say we're out of the problem with the cost of living crisis. On the right here, just to remind you, I've put the Asda weekly income tracker, and this looks at the money in hand that the average family has at the end of the week after they spent money on the essentials of life: groceries, electricity, gas, transport, mortgage payments or rents. At £210, that's sharply lower than the period during COVID when they had furlough payments, and back, I'm afraid, to levels we saw 5 years ago. So we need that cost of living to ease. Risk 3, of course, is that UK inflation is much stickier at the moment than it is in the US or Eurozone. You can see that in the left-hand panel. UK CPI inflation rolling over a little bit, but still at 10.1%. US falling sharply to 4.9%. Of course, they have a lot of their own gas, so they haven't got the same energy pressures. And Europe down to 7.1%. UK clearly the outlier, but I'm pretty certain that we can get these numbers down to about 7% by mid-year. Why? Because on the right-hand panel, UK natural gas prices have collapsed. That'll start flowing into the numbers this month. And on the upper panel, this shocking number of UK food prices, up 17.3%, is at least meeting international food prices, which are now falling quite sharply. So if the UK retailers pass the price increases through, that will benefit households. We may have to push to do that because, as we've talked about in earlier presentations, this concept of greedflation, holding on to retail margins, is quite a feature of the UK economy. So let's wrap this up and see what it means for assets. Well, first of all, if the Bank of England fan chart is right and inflation comes down below 2% somewhere around the end of 2024, it makes UK bond yields on the right-hand box there in the blue line at 5.25%, probably 5.5 or 5.7% if you include bank paper, look really quite attractive as a core to underlying portfolios. The second conclusion, which we've talked about before, is all of this is quite good for sterling. Yes, the economic gap is narrowing, that's good for the currency, and also the dollar index itself is falling. You can see in that left-hand panel the continued decline in the dollar index. In red, the difference between a US T-bond and a US gilt yield. The US T-bond used to have a higher yield. It now has a lower yield. That's good for flow of funds. And finally, the chart we've looked at many times in these presentations before. Sterling, sterling index plotted against geopolitical crises. And you can see that sharp fall off and then the recovery. If Sunak-Hunt duo can continue to improve financial stability, and if Labour in terms of financial policy continues to tack to the centre, there isn't that geopolitical risk, and that's good for sterling flows. So I hope that's a good snapshot of the UK economy and gives you two helpful ideas to incorporate into your portfolios. Thank you.